Is John Bossian. I'm a first-year MBA student at the Harvard Business School, and I'm a co-chair of this panel with Anas. Do you want to introduce yourself as well?
Yes, I'm Anas Al-Jumaili. I'm also first year at Harvard Business School, and I'm co-chairing this panel with John.
And we're both very, very excited to have you all here. I'm going to be moderating this panel. As you may have seen from the website, my name is John, but I'm not John Kemp. So John Kemp is right here. We'll have a little bit of a different structure with four kind of direct panelists, which I think will be great for all of us because we can get the opinions of all these four distinguished guests. So without further ado, since we're starting 10 minutes late, we'll try to end 10 minutes late as well, so it gives enough time for people to go back and hear the next talk for the keynote speech. I'll now present our distinguished panelists and then start off straight with a series of questions. Just a couple of ground rules before we get started. We're planning on running this session 35-25, so 35 minutes of kind of maybe dialogue between the distinguished guests, and then 25 minutes of Q&A. So please, if any question kind of pops up, please keep it in for the end, so we'll have an ample amount of time to do that. So without further ado, from right to left, we have John Kemp. John Kemp is a senior market analyst at Thomson Reuters, and he specializes in oil and has a lot of expertise. And we're excited to have you here, John. Professor Dr. Anas AlHajji is chief economist at Natural Gas Partners, and is over here, I believe, from Houston. Is that
Dallas?
From Dallas. So thank you for being here. Azza Fawzi is VP of Finance in Deepwater Upstream at Shell, and we're happy to have you here as well. I believe you flew in from New Orleans. Great. And then finally we have George Sarraf. George Sarraf has 19 or almost 20 years of experience at Strategy which used to be at Booz & Co., so in management consulting in the region. So we're excited to have everybody here. And what we're discussing is the oil price decline and its consequences on the Arab world. So without further ado, I'd like to ask a first question, and then please chime in as you want. So first question would be, why have oil prices plunged since mid-2014 after 4 years of relatively high prices and stable prices?
I would like to take that. We've seen massive disruptions, production disruptions, mostly because of the Arab Spring and the sanctions on Iran. And with those disruptions, basically, prices should have gone to $200 or more. But that was not the case. We've seen massive increase in U.S. oil production. Just to show you the amount of the increase alone is more than the exports of Kuwait and United Arab Emirates alone. And then after that, we've seen decline in those disruptions, and we ended up with a surplus. And here is the problem. Saudi Arabia cannot cut production at all, and they have no other choice but to continue production and increase it later, for a simple fact that the quality of a crude that the United States brought in is light sweet crude, while the Saudi crude is mostly sour and tend to be heavier in some areas. All the exports to the United States are heavier and sour. So if they cut that crude, it's the wrong market, it's the wrong crude. So they have to maintain the high production to achieve various objectives. Shortly, the objectives are to maintain market share in crude, NGLs, that natural gas liquids, and products, petroleum products, and petrochemicals. So it's not only about crude.
Let's see if I can get this to work. If I could add to that, I would like to add to that.
Forward.
Oh, thank you very much. Just to add to that, it's more of a long-term game as well. So, there was expectations that the markets would increase in India and China, that the need for production would be needed because of higher demand. That has so far not been the case. It's allowing other markets to enter. The shale oil boom has also increased, the supply. And in terms of many diversified countries, Saudi Arabia has quite a bit downstream or integrated downstream projects in the United States as well. So they're feeding those refineries with the types of crude that they provide.
Maybe I. Okay. I mean, I like to see it supply and demand. To make it simple, as it was mentioned, supply. The expectation were that the supply would not surge, and they did. In fact, that's the story in the U.S., but also you have the story in Iraq and in Libya, where in fact the disruption and the conflict did not yield to a decrease in production. And so, this is mostly a supply story. I mean, there is a weakening demand story in China, etc., but it's mostly a supply story. It's in contrast with what happened in 2008 during the recession, where the same thing happened. The oil prices dropped dramatically. In fact, if you compare the two, at that time in 2008, it was mostly a demand destruction that happened overnight, and basically the drop was actually more severe than the drop we witnessed over 6 to 8 months, from 100 to 50. At that time, so now it's a supply story. In 2008 it was a demand story, but at that time things rebounded fairly quickly because the response of the industry was very different than today, and maybe this is something we can discuss as well.
I mean, to amplify what George was saying, President Nixon's chief economic advisor, Herb Stein, used to say that if something couldn't continue forever, it will stop. And the problem with oil prices at above $100 a barrel was that they were curbing demand growth too much and incentivizing too much supply. Between 2005 and 2014, oil demand in the non-OECD economies grew by about 12 million barrels a day. Over the same period, oil demand in the OECD economies fell by 5 million barrels a day. So you have a net demand gain over that period of 7 million barrels. At the same time, you have the shale revolution in the United States, which brings on roughly an extra 4.5 million barrels a day of production. So the United States was capturing almost all of the marginal increase in oil demand. And those trends were getting significantly worse in 2014. You see a very rapid acceleration in shale drilling in the United States and a rapid acceleration in shale production. And at the same time, oil demand is not only dropping in the developed countries, but oil demand growth is starting to taper off in the developing countries as well. So you had this massive incipient surplus, and it was really only a matter of time before prices began to drop, and drop quite severely in order to bring the market back into balance. The immediate triggers appear to have been a couple of things. The first was there was a big build-up of speculative positions in the oil market in the first part of 2014, and they unwound. There was an anticipation that as ISIL swept across northern Iraq, that it would take a lot of Iraqi oil and Kurdish oil production offline. And when that didn't happen, again, that was a big trigger. As my colleagues have noted, Libyan oil exports remained remarkably robust, particularly in the late summer of 2014. And then towards the end of the year, OPEC refused to cut production. So those factors triggered that big price collapse. But it was coming anyway because the oil market was on a fundamentally unsustainable course with prices above $100 a barrel.
Great. So a few of you have mentioned the shale oil revolution. So I'd love to hear from Dr. AlHajji. So several dozens shale oil projects have been basically tabled now. Could you give us your perspective on how U.S. and also non-U.S. shale producer will be reacting to this situation?
The best way to explain this is if you look at the numbers for October this year versus October last year. In October last year, the EIA, that's the Energy Information Administration, was predicting, or the prediction of the EIA in October 2014 of production in October 2015 is 1 million barrels higher than the actual number. So in a sense, if the Saudis' objective is to stop the growth in shale, they already achieved that. So we already have seen the reaction. But we don't live in a static world. We live in a very dynamic world. So we've seen reaction. Yes, we've seen cut in spending, sometimes up to 40% in some companies, but we've seen improvement in technology, we've seen improvement in productivity, we've seen improvement in management efficiencies, etc. The decline in cost that we witnessed, basically some of it is reversible as prices go up, but some of them are not. So many of those companies survive simply on improvement in productivity.
I'll just add to that from my experience at Shell and in the unconventionals region. So we have had quite a good track record with unconventional production over the last several years. But I look at this as oil prices drop, is never waste a good crisis. So for us, it's really looking at the efficiency of our operations. And our shale producers within the company have been able to take out about $1 billion of cost, but still maintain the same production. So it's a very elastic business, and it's also has a very high peak, and then it immediately declines. So it's really being that nimble to produce as quickly as you can to keep and to get your break-even price as low as possible. So that's what people, at least in Shell, that's what they work on that basis.
One maybe follow-up question on that. So, we talked about shale. I'd love to also kind of, cover deep water. So in a similar vein, my question to you, Azza, would be, what do you think the impact will be on deep water? So specifically, I think Shell recently acquired British Gas, which has a lot of exposure to deep water. So does that signal that the industry thinks that these low prices are not kind of sustainable and they will go back up?
I think it's going to be, as we've been hearing in the press lately, longer or lower for longer. And these are large, Shell is a large integrated operation. So we are helped by the integration of our different assets in the refining area and the upstream as well as the downstream. Deep water is not for the small company or the faint-hearted. It has a lot to do with technology and the bringing in of new technologies. Not for technology's sake, but more for technology for the sake of providing safe, efficient production. So if you see in the deep water space, Shell, by the way, hasn't yet acquired BG. We're in the process of completion, and hopefully that will complete sometime in early next year. But on that basis, really, it was looking to purchase it for its integrated gas as well as deep water positions in the world. But break-even prices are very reasonable and very good in the Gulf of Mexico, as an example. So it's really the different types of TLP, tension-like platforms, spars that we have been very successful in the Gulf of Mexico. Brazil brings a different type of deep water, which is the floating processing and storage facilities, operations and vessels. So those are really floaters, floating processing FPSOs, they're called. But they also bring a great deal of expertise. So where Shell has a few FPSOs, Brazil has 20, 25, and orders them in bulk. So Petrobras is the expert in that area, and we work with them very closely, and BG does as well. So we're hopeful that brings in more economies of scale and critical mass in that space.
Maybe a question to everyone. So what will happen when sanctions on Iran are lifted? Any thoughts or perspective on that? And I'd love to hear from as many of you as possible.
So there's going to be a sort of a staged response in terms of Iranian production. Iran currently has something in the order of 30 million barrels of oil and condensates stored in tankers floating in the Gulf. And the likelihood is that they will put that into the market once sanctions are lifted, probably at the rate of something like 250 to 500,000 barrels per day over a period of about 6 months. The second stage for Iran will be to turn the taps back on in some of the oil fields that they've had to mothball during the sanctions period. And that could give them potentially an increase of production. And there are various estimates, but in the 500,000 to 1 million barrels a day range. And they should be able to complete that by the end of 2016. The bigger challenge ultimately is to restore some of the production that they have lost in the longer term as a result of both the revolution, the war with Iraq, 2 lots of US sanctions, and that is going to require quite a lot of investment in the oil fields, and that's probably going to take them longer. But their ambition is certainly by the end of 2016 to push production back to pre-sanctions levels, and then to carry on growing it. And by the end of sort of 2018 or 2020, we could easily see an extra 2 million barrels a day of Iranian oil production on the market.
Maybe to add, is this working? Yeah. I think we're just beginning to understand Iran. The country has been obviously isolated for quite some time, but there are certain data points I think that are important. Number one, Iran is the 4th, maybe the 3rd largest reserve holder of oil, and the 1st or the 2nd largest reserve holder of gas. So it's a significant global player. Okay. Second, pre-Islamic Revolution in 1979, Iran produced 6 million barrels per day. 6 million barrels per day, you contrast that with 2.8 production today. So that's the magnitude of the comeback, right? Irrespective of oil prices, irrespective of sanctions. I mean, just by turning on certain wells again, that's the extent of the surge. Now, the plan they have in mind is to increase capacity to 5 million barrels per day, I think, by 2020. I think they will face, obviously, a lot of challenges. It's not easy to bring capacity in such a short period of time from where it is today to 5 million barrels per day. But clearly, I mean, the Iran, and as an OPEC also member, will play a very important role in the future supply and demand of oil. Especially another important data point is that for Iran budget to balance, they need an oil price in excess of, I think, 110 or 120 right now, because of the massive subsidies, so on and so forth. And so, the current oil price is not great news, obviously.
Maybe one more question, maybe before we switch screens. It's always very difficult to predict what will happen. But if you were to hypothesize or theorize on when prices might rise again and by how much, what would be your prognosis?
If I know, I would be working for myself.
I mean, I'll hazard. I think we can put an order of magnitude on it, in the sense that the market probably needs an oil price of somewhere between $55 and $75 a barrel to bring supply and demand back into balance. Is this not working? Is that better? Is that better? Okay. So the market probably needs an oil price of between $55 and $75 a barrel to balance. We know, and that's really based on the break-even costs of North America's shale producers. We know that at prices below $50 a barrel, the shale sector is struggling, and US oil production is falling quite quickly. We also know that at prices above about $60 a barrel, most US shale oil producers will look to ramp up their production. So that is probably, and they are currently the marginal barrel of oil in the market, so that is probably the range that we are looking to get back to. However, the market is currently oversupplied. There is quite a big build-up of inventory globally, which will need to be worked off first. So I think we're probably looking at returning to a price of sort of $55, $75 a barrel, but towards the back end of 2016 and in early 2017, when some of that surplus has been worked down.
No, please go ahead.
Okay.
It turns off by itself, I think.
I don't know what's going on.
Just try. There you go.
Okay. I mean, I would support the statement made that we cannot. It's very hard to predict, and the way we look at it is through signposts. There are some major signposts that can swing this story in one way or the other for oil prices. What is certain is that oil price will remain very volatile. That's for sure. And they have been actually much more volatile than they used to be. So if you plot volatility, you can see the great difference. Now, the signposts, one clear signpost is climate change. You know, how serious are the G7 and the G20 in embracing climate change will have a major effect on substitution. And so that is a big swing factor on demand. The other one is obviously China. How fast will China rebound? Will it do that in the coming few months, or that will it take China a couple of years to go back where it was in terms of growth? I think the response of OPEC is a big unknown. There is a December meeting that will make a big difference in terms of where the oil price would go. What conflicts that are happening not only in the Middle East but elsewhere as well will have, what kind of impact will they have on disrupting supply? And technology is a big important element. We've seen how technology has improved the economics of whether deep water or the shale oil revolution. I mean, there is a lot to be done there. A lot of research is happening. So the disruption that can come from technology also can play a major role in making a lot of the supply today more economical.
If I add to that and just sort of tie it together, and we spoke a little bit about Iran coming back, for OPEC countries to maintain their market share and to keep, the prices will remain low for longer. So I would imagine that, don't anticipate over $90 or $100 anytime in the near future on that basis.
And I think that's a good segue into the next part of the discussion. So at some point I thought to myself, well, why are we even discussing this? I mean, isn't it a good thing that prices are low? For the end consumer, it might be a good thing. And then, we kind of discussed and we said, well, maybe kind of tying it back to what you said about the budgets of OPEC countries being, tightly tied to oil revenues, and these governments in general having not diversified away that risk. The question is, who are the most vulnerable OPEC countries, and how vulnerable are they really? We would love to get your perspective on that.
Yeah, I can take that. So, I mean, oil producers are not all equal in front of this drop in oil prices. If you measure this impact by the oil price that they require to balance their budget, you see countries that can balance their budget at 60, and that's based on the budget of 2015. So if you cut a little bit in that budget, you can very well survive at 50. That's countries like Kuwait, like Qatar, to a certain degree, the UAE as well, would survive within that environment easily, relatively easily. But countries like Saudi Arabia, Nigeria, Venezuela, Algeria would have great difficulties operating in an environment where oil price is $50 on a sustained basis. Now, even within that group, all countries are not equal. Some countries have very low debt to GDP ratios. Take Saudi Arabia. It's almost negligible compared to other countries where they have more. Also, the amount of reserve they have is quite different between Saudi Arabia and other countries. So some countries in that bucket, right, can weather the storm more easily than others as well. So very different kind of impact across all these countries.
A couple of things on this point. Let's remember that those countries experienced prices below $10 in the 80s in the mid-'80s, at $10 in 98, 99, and we did not see any revolution. We did not see any political change. In fact, the only political change happened was a democratic change in Venezuela. That's the only thing that happened. But none of those countries, basically, we've seen a major change in politics or in the leadership or anything at all. So they can survive. And therefore, what we did to kind of try to understand those issues is at NGP, we created three prices. You already heard about the price needed for the budget, but we made a slight change to it. It's the price needed to support spending rather than to balance the budget. And then we looked at the social cost, and we looked at something called the pain price. And that pain price basically is the most important, because if prices go below it, then you will have political instability, you'll end up with social problems, and you end up with some issues in those countries. And based on what we've seen until now, there is something very interesting, that if you look at, okay, how low can prices go? And what we found out was, for the United States companies, you need, after the decline in costs, you need a price in the high 30s, low 40s to maintain what we call the cash cost. For those who are studying economics, we are talking about the variable cost. If prices go below it, then people will shut down. Notice that every time prices went to that level, they went up again. So we have a floor there. And if you look at that pain price in those OPEC countries, based on our calculation, it is in the low 40s too. There is a match between the cash cost of the companies and the pain price of those countries. So it is very clear that the price could be the low price, or the price floor could be in the low 30s, high 30s, low 40s. However, Saudis, if they want, they can crash that floor. They can lower prices below that, but that's not sustainable more than a few days.
You also consider that a lot of the technology that now is required, the old easy oil is gone. You have to have more enhanced oil recovery, more technology-based, and more expensive. So to maintain what you currently have, that's possible at those prices, but longer term, you will need to see a rebound in order to bring in the new projects that many are being delayed or canceled at this point.
I mean, I scribbled down a few numbers to try and give you some idea about the magnitude of the impact of lower oil prices on the Arab countries and the OPEC countries in particular. Across what UNCTAD calls its Western Asia group, which is the GCC plus Iraq, Yemen, and up through Jordan and Lebanon, oil and gas accounts for about 80% of export earnings for that country. For that country group on average, and it's about 40% of their GDP. In the case of Saudi Arabia, we're talking about 87% of export earnings and 46% of GDP. So these are some of the most commodity dependent and specifically oil and gas dependent countries on the planet. And the fall in oil prices has cut their combined export revenues by on order of $360 billion a year. Compared with 2014. So we're talking about a really quite enormous financial impact for them. It has at least three big implications. The first is quite a big slowdown in their growth. On average, those economies grew their GDP by about 6% a year since 2000. And now in 2015 and 2016, the IMF expects their growth rate to slow by about half to just 3% on average. They were running current account surpluses of about 25% of GDP and accumulating large financial reserves. And for the group as a whole, that current account position is essentially expected to go to basically zero in 2015 and 2016. And they were running government budget surpluses on average of the order of 10 to 15% of GDP. And that is expected to switch to government budget deficits of 10 to 15% of GDP. So we're talking about quite a big turnaround in both economic performance and government finances. Now, some of those countries, and I'm thinking about Kuwait, Saudi Arabia, the UAE, built up really quite substantial financial reserves during the good years, and that allows them to adjust government spending much more slowly. But for the other countries, for the other oil exporters, and I'm thinking countries particularly like Iraq, they don't have the luxury of that. They do not have substantial reserves. Venezuela falls into that category as well. And they face a much more immediate and much more urgent adjustment process that's going to put a lot more pressure both on government budgets and on their political systems.
Maybe a couple more questions. So one is kind of moving from the more short-term ways that governments can maybe palliate that situation to more long-term ways. You know, it brought to bear the example of Norway that really kind of diversified their investments much early on, since maybe the 70s or the 80s. What are the things that you think countries like Saudi Arabia could do to really diversify their activities, at least from a financial point of view, in order to be able to weather these storms, if not kind of better, you know, more swiftly than what we're seeing this time around?
I'm going to put my professor's hat and take issue with 2 points in the question itself. There is no way we can compare Norway to other countries. They are in different pockets. So the comparison, basically, in my view, is not valid. And I'm going to say something that may not be or could be shocking to many of you, that the solution, especially for Saudi Arabia, is to concentrate more on oil and energy rather than to diversify. And John and I have been talking about this earlier. Think about it this way, that in Saudi Arabia now, the top experts are still from France or Italy, and both of them do not have a single drop of oil. So why not the top experts are coming from Saudi Arabia? Why the top technology is still coming from Houston, not coming from Saudi Arabia? So in a sense, concentration in this case will allow them basically to benefit from technology and human resources and export it to the rest of the world. If they are 90% dependent on oil, depending on whether you consider petrochemicals are related to oil or not, okay, reduce it by 20%. Reduce it to 70%. Reduce it 60%. They are still dependent on oil. 50%, which is a dream, they are still dependent on oil. So they cannot get rid of that. And every time prices go up, they will be more dependent on oil. So the idea here is, for those who are Arabic speakers, by the way, you can read an article on the web, عنوانه لماذا تهربون من النفط. It exactly points to this point that there are many benefits to concentration for those countries than diversification.
If you take the integration, so I mean, Saudi Arabia has a number of refineries in the United States under the title of Motiva. So if you take the integrated side and you look at that, that's really where the diversification within the oil and gas industry, building on the point. I don't think it's realistic to believe that they're going to be not dependent on it over the time, because this is their main resource. It's also a country that is mainly desert. There isn't a lot more, if they could have, they would have already. So in my view, I think in many places in the Middle East, it's understanding and working closely with other IOCs that can bring that technology to bear in their countries. And we've seen very good examples of that in Qatar, for example. I was involved there for a number of years with Pearl GTL. So it's the largest integrated gas plant in the world. And it's taking gas from the North Field, which has very good and very positive returns for both partners, and really turning it into oil products and on such. You have in Qatar, for example, you have the Qatar Gas, which has not just the gas plant, but it has extremely rich condensate that is associated with it. So even as they weather the storm and gas prices will go down, they are able to profit tremendously from the condensate. So it's more focusing, as you say, on what they do very well and doing it even better.
Yeah. I subscribe to the diversification within the oil and gas value chain. Mm-hmm. Okay, there's no point in trying to do a lot of other things when your core capabilities and your core competitive advantage is in oil and gas. However, there are things you can do. I mean, you can localize supply chains that serve the oil and gas industry, and there is a lot of movement around that actually happening today. But I think one important point that we find in those economies, I think, is that the role of the private sector is to a large degree limited. I mean, compared to Western economies, the private sector has a very small share of the economy. And I think there is a need to reform a lot of these sectors to allow more private sector participation in many aspects. I know there are initiatives underway, but they're faced with challenges. So I think those economies should be more open toward private sector, whether they are local or whether they are international. I think that's anyway. The other small data point I wanted to make is that, if I'm not mistaken, Iran, I mean, the contribution to revenue from oil is like 30%, maybe, or something. So it's funny, but Iran is the most diversified oil and gas producer today because it has a large manufacturing base, and so that it was able to keep,
Had no choice, really.
Well, I had no choice. So, just to get that data point also maybe in perspective.
I mean, we talk about the need for diversification. I started work on oil and gas issues in 1996, 97, when oil prices were very low, and everybody was talking about the importance of the Gulf countries diversifying away from oil and gas. Fast forward almost 20 years through periods of both high prices and low prices, and we still haven't seen any meaningful diversification. So I'm very pessimistic about the possibility of diversifying away, and therefore I think I agree with my colleagues. The challenge for them is to unlock greater value from within the sector that they're very good at, rather than trying to sort of substantially diversify their economies. It would be a lovely idea, and the IMF is currently pushing them very hard to diversify, but the experience of the past 20 years, and we can go back 40 years, suggests that diversification simply won't happen.
Okay, thank you all for your contributions. I'd like to maybe now open it up to questions. So the way we'll do this is I'll pick a person, and then there's a little button there where you can activate your microphone so everybody can hear your question.